I'm Dylan Smith, and welcome to a special episode of the Rosenberg Roundup. This is the latest in our occasional series of interviews with thinkers and influencers in the world of macroeconomics and finance. And who better to talk to today than the big cheese himself, our founder and president, our chief economist, the point writer of the Rosenberg Roundup, the Butch Cassidy to my Sundance Kid. It's David Rosenberg himself. Dave, thanks for coming onto the show. We've been speaking a lot in the weekly podcast about the bull market in equities that has in many ways defined the first half of the year. And we've been highlighting the reasons that it makes us a little nervous, from soaring valuations to very weak breadth in the underlying movements. You've published a long and I must say masterful note on this recently, drawing on your experiences in the bull markets of the 90s and 2000s. So we'll focus a lot on that in today's episode. And of course, we're speaking not long after the first presidential debate, so we'll have to touch a bit on what that might mean for markets. Okay, so let's get going. Dave, I'll start you off with a few numbers. The S&P 500 is up about 15% year to date, but more than half of the constituents are down on the year. Value stocks have been losing you money, but growth stocks are up over 20%. Way more than half of the S&P 500 return has been driven by just 5 companies, and a full third of it from one stock, that of course being NVIDIA. And if you look more broadly than just the S&P 500, you get the Russell 2000 index of smaller companies being absolutely flat on the year. So here's my question to you. Is this even a bull market?
Well, it is certainly a bull market in the headline indices, and it's a bull market in passive investing. But as you had mentioned, the average stock in the S&P 500 is actually no higher today than it was in early January of 2022. I mean, that's 18 months of nothing for the average stock. So it's, as you said, we have an extremely bifurcated market. It looks a lot like the late 1990s. And we have 3 mega caps now accounting for over 20% of the S&P 500 market cap. That is an unprecedented degree of concentration dating back to 1980. And we have just 25% of individual stocks beating the index year to date, which also is an unprecedented degree of underperformance dating back to 1974. So let's just say that we can debate, is it a bull market? Is it a bear market? But I prefer to use the other B, bifurcated market.
So we're looking at a highly bifurcated market. Could you maybe describe a little bit around how you think about investing personally and how that kind of makes you look at this current market?
Well, I come from a philosophy that the business cycle is never repealed. I think there's a lot of people out there that threw in the recession towel that think we will never see a recession again. I believe that interest rates matter. The economy resets to interest rate shifts in both directions with long lags. But the business cycle has not been repealed. And I also believe in another basic concept, which is diversification. Which has gotten a bad rap this cycle because really you have such intense concentration in the market in these $3 trillion mega caps that have carried the load. But I do believe that especially now diversification is going to be very important. I believe that investors should be focused not on just expected gross returns, but risk-adjusted returns. And nobody seems to do the good old Sharpe ratio anymore. Nobody seems to try and measure their return performance adjusted for either volatility or for drawdown probabilities. So my philosophy is diversification, capital preservation, and the preservation of cash flows. So I always think of dividend growth, dividend yield, payout ratios. And I also believe when I say about diversification, it's not just within the U.S. equity market and across asset classes, but also diversifying regionally. I tend to find that there is a lot of home bias, especially in North America, when there's a whole other stock market out there, whether it's in Europe or in Asia or in Latin America, and our own models have been very bullish on emerging Asia for some time now. And so we're sticking with that. By and large, that's been a pretty good place to be. And the valuations are just a lot more compelling there than they are over here.
So diversification is sort of big D in terms of how you see investing. The other one I've heard you talk about is the discount rate. So I wonder if you could sort of tell us what the discount rate, measures in stock terms and what it's telling us right now.
Well, the discount rate is important because when you're buying the equity market, you're buying an asset class that is very long duration, especially in the groups that have been carrying the load. So you're buying a long duration asset, which means when you do your valuations, you have to value the future cash flows by something and apply a present value to bring the future values back into the current day. So you need the discount rate to discount those cash flows. So look, back in 2020, 2021, when the discount rate was close to zero, it was like Jack of the Beanstalk. It was like, whether you think it made sense or not, the relative valuation between the earnings yield in the stock market and the 0% risk-free rate ensured that the market would continue to go higher. But you see, what's very interesting in today's mania is that the stock market's behaving as though the discount rate is still close to 0% as opposed to being 5% plus. And so what that does is the math upsets the apple cart, because even though the headline index has made new highs, even though the average stock has not, the equity risk premium for the overall S&P 500 has been whittled down to just a handful of basis points. Normally, you want to get compensated to be in stocks over bonds because stocks are riskier. You need to have a relative valuation in terms of comparative yield of 300 basis points. We're a fraction of that right now. And that's what we've been saying. Of course, it's a tough sell because everybody is seeing how rich they're getting by being long the indices, of course, not looking at what's happening beneath the surface. But you asked me before about, how I invest. And, I'm just peeling off more layers off the onion that I like to invest, and this is just being rational, with the tailwind, not with the headwind. And valuations right now, when you talk the heart of the interest rates, is that they tell you something about relative valuation. And the equity risk premium, I come back to that. You want to buy the stock market when the ERP is very high, not when it's depressed. In some cases, very close to zero. So I find it very interesting, and it's a commentary on human behavior, because so much about investing is emotional and psychological. It's not always about the fundamentals. And so it's against that backdrop that I find that a lot of investors are not looking at risk-adjusted return potential. I don't think valuations are a timing tool, but at any moment of the investing horizon, they will tell you what your expected return should be. And risk-adjusted right now, our models are saying that it's close to zero in the United States. And this is not about being bearish on the stock market, but just that there's other regions of the world that offer more risk-reward attributes.
Okay, so that's how you invest. Let's look at what the latest data tells us about how the average U.S. household invests, which is that they have 71% of their financial assets in equities, and predominantly U.S. equities at that. They're holding about 22% in cash and just 8% in bonds. So, aside from, I think, that not syncing up very well with how you would look at responsible investing, do you see a broader macro problem with that concentration?
I see a very significant demographic problem. And it's not just that. The household sector, as you said, 71% at this stage of the cycle, at the highs or near the highs, that heavily exposed to the equity market is problematic. It just goes to show that nobody thinks that there will be a recession, and nobody thinks that we'll ever see a bear market again. Those are very dangerous propositions, presumptions, and assumptions. And what it also tells me, because this goes against my theme of being diversified, that the household sector, broadly speaking, is extremely concentrated in terms of their exposure to the equity market writ large. Nobody rebalanced. This is, again, what you see in the market sentiment indicators. Greed is trouncing fear like it's nobody's business. And because of the fact there is so much greed out there, and you still hear the term FOMO, fear of missing out, that nobody rebalanced. It's as if taking a profit is the stupidest thing you can do in this environment. However, I think we'll turn back the clock and look at history that now was a time to start rebalancing the portfolio. Nobody booked profits because everybody believes that a bear market will never happen again. Somehow, bear markets and recessions have been outlawed by Mother Nature, and we'll see how that plays out. On top of that, the specific demographic that we've been honing in on is the boomers, that 80 million pig in a python. And we're looking at the age range of 55 to 74. These people hopefully aren't going to drop dead tomorrow, but they're getting older. Of course, they're going to live longer too. And their share of financial assets and equities is around 60%. When I started in the business in the mid 80s, people my age or older were becoming more conservative, more income yield oriented. They weren't completely out of the stock market, but a traditional asset mix for people that are in their late 50s, 60s, into their mid 70s normally would have 30% of their asset mix in the equity market. It's now 60%. And I'm concerned about them. I'm not concerned about my kids. I'm not concerned about you, Dylan. You're in your early 30s. You have a long time to make up for a bear market. But these people in their late 50s, their 60s, their mid 70s, when we do get the inevitable bear market, and reality is that bear markets are inevitable, and so are bull markets. The cycle is the cycle. Economic cycle, the market cycle, the interest rate cycle, the seasons, life itself, everything moves in cycles. And I'm really nervous about what happens to this particular large demographic cohort that will not have time on their side when we move to the other side of the movie on this market cycle. They're going to get creamed. And then the question is how that's going to affect what they had expected all along to have been a very lucrative retirement life. That's going to be jeopardized, and they're clearly not positioned for it.
And do you think, just to quickly touch on that, do you think that current spending is actually partly explained by that? Do we think there's a big wealth effect among this group that's seeing very strong portfolio returns from a highly equity concentrated portfolio and deciding, yeah, let's take the grandkids to Disneyland? And maybe that won't be true when markets turn down a little.
Well, it's quite possible that they're taking the kids to Disneyland. There has been, not just from what's happened in equities, but also residential real estate, there has been a positive wealth effect. There's no doubt about that. In general, of course, people in their 50s, 60s, 70s don't typically do a whole lot of spending out of their income. But people that are in their 30s and 40s and, where household formation tends to pick up and birth rates, fertility rates, you're having your family, you're spending more money, those people certainly are feeling flush. And those are the really big spenders at the margin in the economy. But it's probably, I think that if you look demographic by demographic, you'd find that there's been a positive wealth effect. The wealth effect does exist. The question is, how significant is it? Alongside some other factors that propelled consumer spending over the years, which has now ended, the wealth effect is probably still a big factor. But keep in mind one thing, that there are a lot of actively managed accounts that are not passive accounts. And almost half the market are people that actually buy individual stocks. So although half the market now, over half the market, is passive index investing, half the market is still active investing. And if you're an active investor, you're wondering. Comes down to your question at the beginning, Dylan, where is this bull market? Because if you don't own a handful of stocks, you don't see it. But if you've been a passive investor, because of course the index funds have to buy the market, and when you're buying the market, you're buying 3 mega cap stocks that are 20% of the market cap. So those people are probably feeling pretty good. And the people that are active managers, if you have not been in the mega caps, if you've not had a concentrated portfolio, and that's the thing, if you've basically thrown caution to the wind and you've allowed your portfolio to get so concentrated, that's why you're up, whatever, 15% this year and up 25% in the past year. Because you've allowed your portfolio to become extremely concentrated. So it's interesting how taking on a dangerous strategy has paid off big time for you until it doesn't. And then it comes down to, sure, I feel like I'm rich, and why not take the kids to Disneyland or out to the restaurant, or redo the patio furniture. So there's that stuff going on for sure.
So let's touch a bit on this index funds point, because I think it's important. The great pitch from index funds was, well, the problem with actively managed funds is that some of them perform great and some of them don't perform very well, and you've got a lot of volatility between managers. And if you're trying to do it yourself, you might as well throw darts at a dartboard. Whereas here's this fund that will just give you the average return of the market and charge you very little for it, right? But are we starting to see some of the kind of, maybe call them spillover effects, or as half the market now, more than half the market is in these funds? Do we need to start questioning, what they mean for market efficiency, for macro risk buildup, all that kind of thing?
Well, what it tells me is, the whole nature of what's been happening in this market. People think that they're smart, when in fact they've just been completely lucky. It's been like buying a lottery ticket. You're buying the S&P 500 that is being carried by fewer stocks than was the case even in the late 1990s. People say to me, well, this isn't like the dot-com craze. No, I would say this market is actually in some ways even more dangerous, because the median age of the boomer was a lot younger, and they had time to make up after that horrible bear market that nobody saw coming in 2001 and 2002. These people don't have time on their side once the market rolls over, which it will, because that's what the nature of market rallies. Trying to time it is next to impossible. But in answer to your question, it's a situation where we have intense concentration and passive investing, which means you're investing passively, which means you're not doing any homework. That's what it means. When John Bogle started the first Vanguard index fund, and he was the pioneer, he said at the time that this market would never get to 20%, and now it's 53% of the market. And it's easy. It's like you said, it's low cost. These funds track the index, and so you're buying the index. And I'd be the first to tell you that the best companies in the world are in the S&P 500, but are they the best stocks? Cisco was always a great company. I don't even think it's back to its old high back in 1999/2000. So what it means is that we have people in the market don't understand the stock market. They just think that it's a vehicle to get rich quick. And passive investing means you don't have to ever look at a balance sheet. You don't have to look at an income statement. You don't have to do any fundamental analysis, look at charts. And you could always hire an active manager. The active manager will do that on your behalf. He or she will actually do some work. But now so what's happened is that the preponderance of this passive investing means you have a lot of people in the market that really don't know what they're doing. They're just extremely jealous of their neighbor making a killing on NVIDIA and Microsoft and Apple and Google, and so enough is enough. So you buy an ETF. The thing is that what happens when the movie runs in the opposite direction? Because when you're in a passive fund, Dylan, who's calling you to say, time to get out of Dodge? At least when you have an advisor, they'll call you and say, time to, if you're in love with your portfolio, I always say fall in love with your partner, not your portfolio. Be in love with your portfolio, and your financial advisor can engage in the derivatives market. At least they can maybe sell calls against your position, get some downside portfolio insurance. And nobody's even doing that, because you can see that in the VIX, how depressed it is. So the problem is that once the market is down 5, 10, 15, 20%, it's going to be too late. And that's the thing about bear markets. Bear markets are not like bull markets. Bull markets are an escalator going up. Bear markets are an elevator going down. It's an elevator shaft. And then they're going to all pile out once they're already down 20, 25%. So, it's this is a nice phenomenon on the way up in a bull market, but what happens to these people when they get hurt really bad, and then they're going to redeem, and they'll probably end up redeeming at the lows, and then it's going to be a real shock to confidence. And we're talking here about something really important, which is 80 million baby boomers moving through this cycle who haven't rebalanced. They have it's one thing to have 71% for you, Dylan, in the equity market for a guy who's in his early 30s. Something else with this demographic. A demographic, the boomers that have dominated everything in the past 6 decades, from politics to finance to economics. So we talked about the positive wealth effect. I think that the negative wealth effect is going to be a lot bigger. And that really concerns me.
Okay, so escalator up, elevator down. That's a great analogy. Of course, as you said, the impossible thing to do is timing what exactly triggers that elevator to start dropping. But one possibility maybe is the political outlook. And of course, there's been a big re-rating in probabilities around the U.S. election, and a kind of clouding of potential outcomes around that. Just wanted to ask you, how do you see these moving parts of the kind of political uncertainty, potential election outcomes fitting together? What does that mean for markets? What does that mean for bonds and equities, especially? Like, where are you on that?
Well, I'm really of two minds, and I always say that if you're going to invest around politics, don't make any decisions based on your first hunch, because it's usually wrong. I remember, look, when Ronald Reagan got elected in 1980, the mantra was that he's going to cause World War III. And then we had the onset of the greatest bull market starting in the summer of 82 of all time. And when George H.W. Bush took over from Reagan in 88, the view was that he's just going to continue on with what Reagan had accomplished. But actually, the markets were pretty rough in George H.W. Bush's presidency. And then, of course, we had a recession starting in 1990 and 1991. Then you have Bill Clinton taking over 1992, and people are saying, well, look at this socialist from Arkansas, and get out of the stock market. The stock market did great in Clinton's 8 years. Clinton might have been some socialist with big brainy ideas coming out of Hope, Arkansas. However, who would have thought that in the mid part of his tenure that he would have had Bob Rubin as his Treasury Secretary, that he'd be doing reforms in the labor market that conservatives would feel very good about, or that he'd be cutting capital gains taxes and undergoing deregulation, especially in the telecom sector. Look at the stuff that Clinton did. You would have mistaken him for a Republican based on economic policy. But you see what happened was that in 1994, very critical event, which is we had Newt Gingrich take over Congress, and we had the contract with America. So it's not always about the president. It's also about what is the makeup of Congress. We had Barack Obama come in 2008, another wild-eyed socialist from Chicago, sell the market. Market did great under Obama. Who would have thought? And then, of course, when Trump got elected, If futures were down limit the night of the election, and then we never looked back, right? And so the stock market, speak to people, they were spooked about Trump like they were about Reagan, and everybody was all bearish. And then the markets did a sober second thought and realized we have Trump and we have the Congress taking the House and the Senate, which means we're getting not just deregulation, we're getting tax cuts, and all that happened. Now, I'll take nothing away from Joe Biden. It just goes to show that sometimes it might not be anything about politics. The stock market did fine under Joe Biden's 4 years. Probably nothing to do about Joe Biden, just had to do with the natural course of events from the economy and for the markets. So we tend to overplay the politics. I think in this case, because I think you're referring to the November 5th election, could be more at stake here, but it's hard to know how things will fall out. I'm getting a little more nervous because we have been longstanding bond bulls about what this might look for the bond market. I think that the stock market will just love a Trump presidency. Tariffs or no tariffs, that creates winners and losers. It's not really inflationary, although that's what people think. It's really just a price level shift. But Trump is going to put through some significant tariff increases, much more widespread and deeper than what he did when he was president. And we're going to get extension of the tax cuts that he brought in back in 2017, and we'll probably get additional tax cuts. Like, the one thing that we know is that nobody is running in this election on fiscal integrity. But Trump, lower taxes for corporations, more deregulation. I think that swamps anything happening on tariffs, which would actually maybe hurt the retailing sector of the S&P, which is a relatively small sector. The thing that you and I would have to deal with, and that we are dealing with, is if Trump wins, and of course, and if it's a clean sweep again, what is this going to do to bond supply? As per the fact that the starting point on the deficit when Trump took over in 2016 was just over 3% of GDP. Now, he'd be taking over with the deficit 7% of GDP. And the debt is gone from 105% of GDP to 130% of GDP. So the fiscal situation is just so much more unstable, although it hasn't upset any apple cart just yet. But I think that the bond market could have some problems with a Trump presidency because it'll be viewed as inflationary. It'll be viewed as very pro-animal spirits in favor of risk assets. And on top of that, we don't know what he's going to do as far as Jay Powell is concerned. Will he replace Jay Powell, which he could, and replace Jay Powell with a yes person? So all I can say is that my highest conviction call will be actually the other part of our bond bullion barbell, which is the bullion part, just to be long gold. I think gold will do very well.
Yeah, I think that's a great call. And maybe just to round out and finish on a slightly positive note. So you like gold. Where else would you hide kind of in the equity market? Or any other assets, or internationally, what do you like to look at?
Well, I think cyclically you want to be defensive. So you want to be in areas of the market that have very low sensitivities to, say, GDP, what we call low beta, low volatility, more stable industries whose earnings don't get crushed in a recession. So I'm saying buy what you need, don't buy what you want, or buy the companies that provide what you need, but not those that provide what you want, which means that you want to avoid consumer cyclicals, and you want to own consumer staples, utilities, including pipelines. And I think when rates do come down, and they will come down, it's been delayed in the United States, but it's going to come. So it means income in the equity market becomes that much more important. So screening for dividend growth, dividend yield, in stable, non-recessionary industries. So I mentioned utilities, I mentioned consumer staples. I think healthcare would be a place that you'd want to be invested in if you were still in the stock market. And there's going to be some selective REITs that right now are trading very attractively that, again, provide you that income, which is going to develop a premium as rates come down. When rates come down, you want to own those stocks that give you a good dividend yield and recurring dividend payouts. On top of that, I think you want to invest thematically and with a secular view. I think it'll be a great question to see how the Nvidias and the Microsofts and anything that's remotely connected to AI that's received this PE multiple premium, how they'll behave in a recession. It could well be that they'll surprise us and continue to go up because they are long duration stocks that investors will say, well, we get a recession, but it'll be just a dent or a small deviation from the long-term expected earnings trend line for these companies. By nature, they are growth stocks. We may be surprised that they hold in. I think what ultimately breaks the cycle, this AI investing cycle, not the AI cycle as it pertains to the economy, is when you start to see the sorts of things that happened with fiber optics and telecom equipment back in. It wasn't all about dot-coms. We were rewiring the world because of the internet. And when you start to see order books compress, or things are so rosy-posy priced in that if you just start seeing companies, even like Nvidia, God forbid, even missing by a penny, which Cisco, God forbid, did back in 2001. So that'll be there will not be an economic number, okay? There will not be a Fed move or non-move that's going to have any bearing at all on what's happening in this part of the market. 30% that is technology, and really 20% of the market is really just got AI thumbprints. That will be sector specific. That'll be idiosyncratic. That will not be a macro event. That'll be one of NVIDIA's customers gets into trouble. And that's ultimately was the canary in the coal mine for Nortel, for people that remember that. I'm old enough to remember that. But I would say that you want to invest thematically for the long term. So look, we're quite bullish on commodities. We believe that there is an enduring, a prolonged supply-demand deficit across a lot of commodities. They might not do that well in a recession, but I think that they will decline by far less than they normally do in a recession. But I think that they are, broadly speaking, in a secular bull market. So commodities are a place that you could look at. I mentioned before that I would recommend taking profits out of the nosebleed U.S. market and investing it abroad. We've been very bullish on Japan. We've been very bullish in India. There's other pockets of Asia, and I understand that investing in China's very cheap, but will you ever get your money out? However, there's other parts. There's Taiwan and there's Korea. There's Singapore. There's Hong Kong that are trading at multiples that the U.S. was in the summer of 1982, which marked actually the onset of a secular bull market. So we like emerging Asia within the equity space. And look, I'm not giving up on the bond market. I think we're going to have a recession. I guess maybe me and three other people in the world think that actually the business cycle is still alive and well. That'll come as a big surprise. The Fed will cut rates. We do like Treasury yields. And I can understand why there's people that might not like the 30-year because of the fiscal premium risk. So you could buy the 10-year. I think that they will deliver solid returns in the coming year. My big concern is that if the debate, the Biden-Trump debate, if you want to call it a debate, was a defining feature, and we get a clean sweep. On November 5th, we're going to have to rethink the bond call. Cyclically, right now, I'm not deviating from it. I think that there's a lot of expectations as to what's going to happen post-November the 5th. We'll deal with that when it happens. But we know what happened in the first 2 years of one-party rule under Donald Trump from November 2016 to November 2018. And if you were long bonds, it was not a pretty picture. But interestingly enough, that the peak in bond yields that cycle was when the midterm elections took place, and the Republicans lost the House. next thing you know, you had a monumental rally. So I guess it comes down full circle to your question about politics. I guess that maybe they actually matter more for bonds than they do for equities.
And on that note, Dave, thanks as always for joining us, sharing your wisdom and insight and ideas. Really appreciate it.
Thanks for inviting me back.
Listeners, if you liked hearing from Dave today, you can hear much, much more from him and from the rest of the team by signing up for a 1-month trial of all our research. Just follow the link in the show notes. As always, don't forget to subscribe, leave a comment, spread the word. I'm Dylan Smith, and that was the Rosenberg Roundup.